It's that time of year again when we look back on the year that was and consider what might be in store for the year ahead. Here are our reflections on 2023 and our outlook for economic conditions in 2024. If we start by looking in the rearview mirror, we see that 2023 was, overall, a good year for the U.S. economy. Economic growth was strong, with real gross domestic product, GDP, growing by an average of 3.1% through the first 3 quarters of the year. This rate is more than double the consensus growth forecast as they stood coming into the year. The job market also remained surprisingly strong. Total employment grew every month through November, and the unemployment rate at a recent 3.9% remained quite low by historical standards. While we believe there's room for the unemployment rate to rise modestly in 2024, labor market conditions will likely remain favorable overall. Importantly, inflation also declined sharply in 2023. Consumer prices, as measured by the Consumer Price Index, were up 6.5% on a year-over-year basis at the start of the year, but by October the rate had dropped to 3.2%. Turning to 2024, we forecast the pace of economic growth to downshift to a rate of about 1.5%. Though much slower than 2023, it's still a sound, even healthy pace in our view, and we believe a recession remains unlikely. We look for consumer spending to decelerate from 2023's stronger than expected pace. Still, consumers will likely enter the new year in good financial shape with low debt-to-income ratios, a good level of savings, strong home values, and sound job prospects. However, consumers have worked down much of the excess savings that they had accumulated during the pandemic. As such, consumer spending is likely to grow at a slower rate, more in line with job growth and wage gains, both of which we believe can remain sound. Last but not least, inflation should further ease in 2024, and we currently project the Consumer Price Index to reach the Federal Reserve's target inflation rate of about 2% by mid-year. After that time, the Federal Reserve could begin to lower interest rates. Getting inflation back under control is still key to the outlook in our view. We would not have had so many recession predictions over the last 2 years if it were not for sharply higher interest rates, and we would not have had the jump in interest rates that we've seen if it were not for the elevated inflation environment. Returning inflation to normalized levels should help normalize conditions in many aspects of the economy. Additionally, lower interest rates have historically been good for stock and bond market returns. As 2024 begins, consider reaching out to your Ameriprise financial advisor. They can review your investment strategy and help identify strategies that may benefit you in the new year. Thank you.